Hello to all of you, and thank you for joining us. I am Nancy Sager from Brighter Investing, and I'm here with my colleagues Gary Whitehurst and Kelsey Russell, as well as Sydney England from GSIC. We are so glad that you chose to join us this morning. Today, we're wrapping up a four-session learning series designed to help Georgia foundations deploy many more millions of dollars into our communities and our causes through impact investing. So if you missed any of these sessions, we definitely recommend going back and watching them, downloading the materials, and we will send links for all of this when we send a follow-up email after this session. In the first session, Sydney started us off by explaining the opportunity, why this has become so important to foundations around the country. And then next, we asked, what's in your portfolio? And provided tools to help you examine your holdings for potential misalignment between your mission and what is lurking inside the investment portfolio. And then 2 weeks ago, Sydney led an inspirational conversation really about re-examining the firewall between the mission work and investment management and some ways we had it was a great conversation about ways to sort of break that down. And right now we are going to bring it all together and show you easy ways to incorporate mission and impact into sleeves of your portfolio. So as we just mentioned, we were a little over ambitious when we chose 45 minutes for this webinar. We're going to try to do our best, but we may go long, and we hope that you can all stay through it. We're going to do Q&A at the end to make sure we at least get the material out there. To keep things rolling and keeping things as streamlined as possible, we're not going to go super deep. But we do want to help you see that this is truly something you can start doing in the short term, like this year, where you can. And today we're going to start with basic portfolio construction. So it all starts with your financial assets, your investment portfolio. And today we've picked $10 million as a nice round example figure. These are all examples. Your organization may look much different, but for illustrative purposes, we had to pick something. So 10 it was. And this portfolio has a very important job to do, obviously. It needs to sustain your work. It needs to fund your grants each year. It needs to keep growing with inflation. And it needs to balance your short-term liquidity needs, like your grant-making activities, alongside your long-term growth goals. Now, each year you distribute at least 5% of your assets through grants, maybe more, but today we're going to use 5%, and the rest of the money keeps working in the portfolio. So now you really have two pots of money or portfolios. So on the grant side, you have $500,000. And on the investment portfolio, you've got 9.5 million. And of course, not all foundations have really specific missions and grant making goals, but for the purpose of this exercise, we are giving this sample foundation four specific missions, pillars really, that they try to fund equally. And they are climate and the environment, children's health, economic opportunity, and affordable housing. So now on the investment side, there has to be structure because this portfolio has to deliver returns that will sustain the organization, like we just talked about. And there are four classes of investments that we think about when we're designing the portfolio. The first one is equities, aka stocks. These are publicly traded. Second, fixed income, aka bonds, also publicly traded. The third is cash and very liquid assets like money market accounts. And the fourth is alternatives, which are essentially private investments that aren't traded on public markets like stocks and bonds. And the decision about what percentage is allocated to each of the four classes is called asset allocation. It is the first step in constructing a portfolio, and it's the most important factor in driving overall returns. So here is the sample allocation we created for this webinar. Um, but yours could look very different. And since this allocation is so critical for returns, constructing it is based on a purely financial analysis. So, with that, I am going to turn the mic over to Gary Whitehurst, who is our co-founder and CEO, since he's spent over a quarter of a century in pure finance. So, Gary, take it away, and Kelsey and I will be your color commentary folks along the way.
Thank you, Nancy. I think you just shared that I was old and boring. I really appreciate that. That's awesome. Thank you.
No, you're not
Um,
boring.
anyway, so great to see everybody today. And when we think about investing sustainably, at its core, it's still just investing with very simple goals to give you the liquidity you need in the short term and the growth you need in the long term. That is the exact same as we build sustainable portfolios. There are things we need to know to allocate the portfolio, such as risk tolerance, what's your comfort with downside volatility, and your capacity to take risk within the portfolio. All of that is there just as with any portfolio that you will build. And diversification is a key to all investing that we do. Concentration or having lots of money in one investment is a great way to get to extreme wealth. It's also a great way to get to no wealth. And so we want diversification that gives us a risk-adjusted return along the way. So, what do we mean by diversification? You can see some examples here. One is looking by company size or the market value of outstanding shares. You have large, mid, and small. You can diversify among geography. You have US, you have international, you have emerging markets, and you can diversify among sectors, whether it be technology, agriculture, transportation. The reason you do this again is to spread your risk, and often these investments work. Um, they work differently than others, and so they begin to give you different performance in different types of markets. So you want exposure to all of them. That's there again. Sustainable investing, no different. We're diversifying among these various entities, and so we do that, referencing back Nancy's pie chart she showed earlier, by taking each of those sectors and diversifying within that class. So for equities, you would see a portfolio that looks similar to this. This is only illustrative. It would change per individual client, but you can see there's exposure to international and US. There is the large, mid, and small that are in there, and there's also emerging markets. And so that's very, very common to see that. It's also important to note that all of this work is done before we begin to get into conversations around sustainability or what the independent investments are. So at the end of the day, you're about 90% there when you have allocated the portfolio among various asset classes and various sectors and different types of market capitalization. And you have a portfolio that is very well adjusted for risk and different types of investments. And again, this is before we've chosen any specific investments that the portfolio will be invested in.
And Gary, just to add to that, I mean,
Yeah.
that process would be the same if you were working with an advisor who knew nothing about, mission aligned investing and impact investing. And that process is just it's it's pure finance, as it says, right? So, and that's responsible for about 90% of the portfolio's returns. So, yeah, that part's locked in. but now you're about to get to the fun part.
Yeah, thanks for making that point. I think a lot of times, and Sydney addressed this, I think it was in the last webinar we had, but this whole conversation around fiduciary responsibility. So far, we look like everybody else putting together, or at least what I would say all good investment advisors putting a portfolio together using this method. But part two does get to the fun part. It's where we start to talk about the investments and we start to talk about aligning your portfolio with that world you want to see with your mission. And this is really where the mission, values, and impact can come to life. Um, what you can see here is the UN Sustainable Development Goals. We oftentimes will lead clients through an exercise to kind of talk through and show them what these are, but this is about helping direct the building of that world you want. What are those causes you care about? And how can we find those causes and bring those to life within a portfolio? Um, and so you'll see, Nancy had shown this earlier, but you have your grants that are diversified among different initiatives. We're going to do the same thing with the investments, which is a much bigger pie. And I would argue has at least the same, if not more, impact with the total dollars that are behind it. But this was taking those asset classes and spreading them out among those percentages that Nancy showed earlier. The amounts don't matter as much, just to understand the scale and the fact that we're looking at an overall portfolio.
Yeah, what we're going to try to do is to take, if for this example, we're going to take these four mission pillars and show you ways and places that those kinds of investments can fit in the different asset classes within the portfolio, starting off with your equity sleeve, which is a big one that's probably could be full of things that are not aligned with with your mission, as we talked about two sessions ago. Back to you.
Yeah, you've if you saw one of the earlier webinars, you'll recognize this slide that took several of the largest ETFs and mutual funds, many focused on the S&P 500, and scored them in various categories. Just to give you a quick preview, the scores go from A to F, and F is not the good score you're looking for in these various categories. But you can see how most of these funds score just on their exposure to fossil fuels, deforestation, and some of the other issues that are up here. The good news is, although most portfolios look like this starting out, it's easy to fix. There's a lot of ways with doing a little bit of research about the types of funds you're invested in. You can begin to get these scores from the C's, D's, and F's to the A's and B's, depending on what issues you care about and what issues you want reflected in the portfolio. And when we start to throw all these terms around, it can seem a little bit daunting. When we say you, in the context of this webinar, we're talking about your team. Oftentimes, managing a large portfolio for an institution's got a group of people working on it, and certainly the sustainable investing is no different. You want a full group together to help you achieve what it is you're looking to do. Nancy clearly put the slide together. I see two Michigan flags in here, only one Georgia. It's completely unacceptable. We're going to move on. But you can make that choice. It starts with analysis on what is in your portfolio, and there are websites you can check to say, okay, what is it that we own? Is that consistent with what we care about? And you can choose better alignment within those options. You can invest in mutual funds that have certain screens. They screen for things like fossil fuels, or they screen for other types of issues. You can have specific themes. You might have a theme of a fund that's more diverse. You can screen on ESG data. You can look at particular industries that are avoided in certain funds and certain solutions that other investments are trying to support. There's one example. There are funds out there that are completely fossil fuel free in almost every sector you would pick for these portfolios. And if that was something you wanted to do, if you know what those funds are, you know where they fit in a regular portfolio, and you're able to do the investment analysis, you can replace those funds that score more poorly with funds that actually score well in that area. Same thing if it goes beyond the environment. You care about children's health. You might want to exclude tobacco companies. You can do that within the portfolio and within those tools.
And
Um,
by the way,
and
these are those four pillars for this sample organization that we're using in this webinar.
yeah,
Yeah,
perfect. Thank you.
identifying them.
And then you also have funds that are focused on solutions, whereas values based is about oftentimes removing what you don't want in a portfolio, you can focus very closely on solution providers that invest within the public market. Green Alpha and Addisina are two good examples of that. Kelsey, I know you've done a good bit
Yeah,
of
I have a
research on
special
both.
place in knowing some of the folks at Addisina. So, Addisina is known for their racial justice work and their ETF. That's the JSTC ETF. One of the big things I think that is special about them is their shareholder advocacy. So, they actually use some of their expense ratio to fund nonprofits that provides input back into what they then advocate with their corporate with the investments that they hold. And so they've got a unique model. And, obviously being a part of their ETF, you then are able to participate in those activities and get the information or as shareholders that they're providing. So, yeah, they're another really special, unique approach to that advocacy and mission alignment that can be pulled through with that thread.
And Green Alpha focused on solutions as well for environmental, climate change, resource scarcity, widening inequality. Again, if that's what you're looking for, more solution providers, you can certainly find that to put into a portfolio as well. Um, then there's also a concept called direct indexing. So instead of buying an individual fund or an exchange traded fund or something that you would buy, you actually can buy an index like the S&P 500 or like the Nasdaq, and you can have that portfolio screened for values that are important to you or your organization, and it basically creates a portfolio that mimics the index within 1 to 2%, oftentimes less than that, but it has been aligned more with your strategy. Not going to go too deep into that today, but it's really cool what they can do with direct indexing, and it's one of the easiest ways to begin to bring, if it's important to you to have your values in alignment with your portfolio. It's one of the easiest ways to do it. Um, this is an example here. There's an index called the All Country World Index, and you can see here the yellow. It actually encompasses all of these asset classes. And so there's a way for you to address all four mission pillars by having the portfolio screened, which also gives you a good percentage of the equities that you might use within a portfolio. It depends on your individual investment goals.
And that little chart at the bottom, we showed some of these in the webinar about know what you own. And this is able to compare like how much better your portfolio does versus the comparable one. And there are hundreds and hundreds of metrics that you can use to really refine this plus and minus for to align with your mission, and then have it applied across the entire portfolio.
This is very important to be able to look under the hood, if you will. I see this way too often where people are like, well, here's your sustainable portfolio. And they don't know what's in it. They don't know what it does. They just, whoever their advisor was said, here you go. And I think to the extent that you want to know, to be able to understand what are the differences, what does this look like, you should be able to ask those questions and get answers for them if you choose to invest for sustainability or impact. We're going to do the same thing in fixed income. Again, we're going to diversify between government bonds, corporate bonds, high yield bonds, and you can get better aligned bond funds that actually focus in on lending towards social issues two that we're familiar with are Calvert and Nuveen, but there's certainly a number of bond funds that are out there.
One, Gary, I wanted to pop in.
Yeah.
Clarion Capital is another one that I recently got acquainted with. So I think their unique approach is their ability to drill into municipalities. So looking at a school in a particular neighborhood that's underperforming and finding a bond that you can invest in there. So we'll get to the alternatives piece, but I think the unique part is that we can start to pull things through from a place-based perspective into some of these angles where you might have otherwise had some defaults, right? And so there's just so much creativity, and not in the sense that, in the scary sense, right? It's more around availability and access to solutions and people who are passionate about this space. That gentleman had spent his whole career in the bonds area and had innovated within that space. So I think that's the exciting part is we're in a time where there's things out there like that where we can specialize portfolios even more with that alignment.
And once again, there's potentially a big chunk of your money that could be allocated toward those types of bond funds versus the standard ones that are, might be financing the expansion of fossil fuel capacity or deforestation or something else that might conflict with your mission.
Um, Same thing can apply to your cash, where you want to, where you have funds that are in a money market or funds that are set aside for operating expenses. You can be very purposeful about where that money goes and what that money supports. Kelsey, a couple comments about these.
Yes. So highlighting a few of my favorites, I actually have some of our personal money at Hope Credit Union. They have a checking account, and our good friends at Self Help too. I don't want to diminish them being here in Atlanta, but in particular, I think one thing that stands out about Hope is they have a checking account only available for those that are residents in the Lower Delta, where the majority of their branches are. And the intention around that is that most people have their salaries deposited into their checking account. And so the idea then is it allows that money to compound faster for those whose salary checks are small. So a lot of the research and innovation that they had done was around figuring out how to lift up those in their communities. And so I think that innovation was a special one that we were excited to support from afar with a low interest rate savings account, but that then unlocks that checking account for others. The other one that's interesting to note is Amalgamated Bank. So they are well known for their work around policy. Most notably, they supported reforms in transactions that showed gun purchases or things related to guns that previously had been masked as their cataloging. And so they had done research that would have shown that the ability to track those transactions might have actually mitigated some of the mass shootings that have happened in the past. So really unique angle, but incredibly impactful work. There you can find a lot of information using tools like Mighty Deposits. Unfortunately, with Mighty Deposits, there's some limitations in its ability to highlight things like the policy work that Self-Help and Amalgamated do. But it's a data point that just helps you understand some of the activities and the ability to dig in a little bit more to understand how that mission can be pulled through in this cash space.
Yeah, and there are lots of organizations that we have looked at to build out our support for clients who want to use their cash and equivalents in better ways.
And you can also do this. We do the same kind of analysis, the same things when it comes to alternatives in the portfolio. Oftentimes, when people think about impact, they think about alternatives or private investments, capital going to solve direct problems that we have. It's one of the easiest ways to start to find impact because you know exactly what you're investing in, and those dollars are going to those dollars are going to a solution provider. Kelsey, I know you are very passionate about this area and know a good bit about these opportunities that are there. So I'll let you kind of go through some of these things.
Yeah, I think I might even tag in Sydney a little bit to comment because now, granted, I'm newer to the impact investing space, but I think what was fascinating to me as I started exploring more and more is the word impact investing means so many different things to so many different people. And a lot of times, I think when I would talk to people about impact investing, a lot of the term angled into this alternative space and place-based. And so I think it's interesting as we think about just investing in general and this idea that investing with purpose or intention can have so many different facets. So Sydney, I don't know before I dive into some of these different components, if you have any comments on what we've come to so far, or even the last slide, maybe I'll pop back to the last one. Um,
Yeah, and thanks. I will have to jump to another meeting here in a minute.
I'm
But
glad I told you now.
yeah, yeah, I know. My day got busy here. No, I think this is great framing, and I really appreciate y'all going through the different sort of asset sleeves. I think what one of the things that I like to clarify with boards especially is um, it is really thinking about the nomenclature. I think local investment, like as it's reflected here on this pie chart, um, is its sort of own asset class,
Mm,
and you have the opportunity, you board members, those that sort of are influencing the deployment strategies, have the opportunity to define the parameters of that new asset class. Like, what are the permissible investment types? What are the general sort of return expectations? What are the risks that you're willing to take? What are the risks that you're not willing to take? So you have the opportunity to define how that asset class behaves, and therefore what you are willing to consider when deploying that 20%. It can also be a lens that is overlaid in different, so it doesn't have to be its own asset class. I think that that is the easiest way to potentially take different risks on your local community than perhaps your like um, OCIO would be willing to incorporate in some of these other sleeves. You may not win the argument when it comes to like how are we really redefining what real estate means or how it behaves in your portfolio, but you have an easier time if it's just like a separate asset class in and of itself. So I would just say that,
mm,
local impact investing can be a carve out. It can be a lens that is used to direct or redirect the companies that fall within these other sleeves
mm,
already, right? And so I
mhm,
think it just depends on, um, you know, what your comfort level is with your board right now, like
mhm,
how comfortable are they defining the guidelines for a new asset class? What is your
mhm,
financial advisor, your wealth manager, your OCIO willing to do as far as playing with the existing allocations, like all of that. And so I just wanted to uplift that
mhm,
it could be a carve out. It can be achieved within the existing allocations. They're just sort of personnel dependencies,
mhm, mhm,
either on the board, the investment committee, or your investment manager, and like what they're willing to do within your existing IPS.
mm, mhm.
Great point.
Yeah. And I know you got to run, Sydney,
Yeah,
so I'll catch up with you. I'm sure you'll see the recording too. I might follow on.
sounds great. All right, bye, y'all.
See you, Sydney.
So I think that's one of the interesting points, and I think in recent conversations too has come up around how do we step through what we know, and use that as a backdrop for what that future state could be. So around those local investments, if I kind of blend that in real estate and consider affordable housing, that's a local development. And let's say it's at an AFR rate. Well, that AFR rate is, you might say, is comparable to your fixed income sleeve, which then you say, okay, well, how do I compare that to the historical performance of bonds? And if that's your reference point, then this is actually really comparable and maybe even better performance than the historical bonds. So I think what Sydney said there is a really astute way of being able to enter into those conversations with the board and even your advisors around how they consider that as its own asset class. I think that's a brilliant way to frame it. And I think that's a lot of how we talk about it and with the backdrop of understanding that there's an overarching return expectation for the portfolio. So layering in that angle, I think allows you to open even more doors. And similarly, Gary, I'm sorry, I'm running through
You're
the
good.
so loans for renewable energy, we have some of those that are 12% plus returns. So then that then allows you to have even more angles on the return expectations and performance. So I think again, you start to consider all of these layered in, and it provides so many more options to then consider these different PRIs then diversified across the portfolio. So I think the key message here is where Nancy's going to take over. Sorry, I had one more around the venture capital, but this thread of personalization, customization according to your mission, and the foundation strategies can be brought through in each of these different slippers within the space. But Nancy, I know you're going to close with kind of this overarching what's possible. So I'm going to hand it back to you.
I'm so bummed that Sydney had to leave because this is slide 34 of the of the 40. So we've made it through. I'm going to wrap this up and then we're going to open it up for Q&A. GSIC and Brighter created this series to inspire all of you to see the opportunity that mission aligned and impact investing creates for Georgia. In the first session, here's one here's one of Sydney's slides that talks about how 5% of U.S. foundations have ventured into this territory of impact investing for, and its iterations. And the rest of the world is actually way ahead of that for great reasons. The tremendous community need, the fact that so many organizations have lost funding here in the US, the fact that many problems are actually better suited for investments versus grants, and the very loud voices of donors and next gen leaders who have different ideas about how they want to fulfill their mission with their money. So in Georgia to hit that 5% figure that we see across the rest of the US, we need 80 foundations doing this. So that's everyone here and a lot more. And we hope that this session has shown you that it isn't just something that's possible, it's something that you can start now, like this year. And Sydney also showed us, there are a lot of myths around this space, and the myths have been busted. And today we mentioned how 90% or so of your financial returns are based on portfolio construction alone. That's a purely financial exercise. And how mission aligned and impact investments can fit into every asset class of a portfolio. You do not have to sacrifice returns to do this. That has been proven over and over again. It just takes a good allocation and good selection of the investments that populate it. So we'd like to leave you with this. This is a different look at that $10 million in assets. So in the orange at the bottom, we have the 125K in grants for each one of those mission areas. So $500,000 total that's, directly supporting the mission. But look at all of these opportunities throughout the rest of the portfolio, all of the green section. Every green line can be better aligned to support these grant areas. And it doesn't have to happen all at once. It can happen over time. It is something that you could start doing now, and evolve as you go. This is a way that a lot of organizations get started. They don't just, wipe the slate clean and start over. And the need is there, and the need is now. So one final note, if you are going to the MIE conference, we would love to meet up with you. Sydney and Kelsey and I will all be there. We're also working on a breakfast about affordable housing. It's going to be on Tuesday or Wednesday morning, finishing up the details, but we'll be sending out invitations when we firm that up. So if that is part of your mission, we would love to see you there. So thank you, all of you, for joining us for this series. Here's our contact info to get in touch. Any and all of us would love to talk with you about any of your questions, large or small. And on that note, it is time for some Q&A. So let me turn off these slides, and we'd love to talk about what we covered today and what thoughts are going through your mind. And there we are. So do we have any questions or thoughts or critiques, ideas, experiences that you folks have?
Yeah, I
Yeah.
guess I wanted to check kind of my understanding on something.
Mhm.
So from earlier in the presentation, I believe Gary was discussing the sleeves. And the sleeves would be where you're like within a fund, you're only like you're able to tailor the fund so that certain, like let's say you were, trying to avoid military weapons, you're able to not have that part included, but the rest of the fund. Am I understanding that correctly, or how would you reshape that?
Yeah, so you are correct. There's a little bit of nuance there. So if it's what I would call a prepackaged product, you buy a mutual fund or you buy an exchange traded fund, which is the iShares S&P 500. Those are pre-screened, and you can figure those can be pre-screened, and those are out there with different variations. So you might find one that has no fossil fuels or has very low prison operations that are involved, or other types of causes. There's a lot of them that are out there. You can't customize it, but there's a lot of funds that are customized.
I see.
But if you want to use a concept called direct indexing, which means instead of buying a fund, you actually have an index, but you own the individual securities within an investment account, you can then tailor that account and that index to your values specifically, and do that while mimicking the return very closely of the index. So if you've got a product where you own the individual securities, you can do a lot of this customization yourself. Oftentimes that depends on the size of the account. It needs to be a little bit bigger to be able to do direct indexing, but you've got a lot of choice. And even if it were a smaller account or a smaller allocation, you can find a lot of funds out there and that look for specific causes that they try to either screen out or focus on.
Great, thank you. That's really clarifying.
Perfect.
And Stephen, you actually, I think, would really enjoy poking around a bit on the As You Sow website. So I'll drop that in the chat. That's a great place if you're looking at particular issues that we learned that was from session, was that 2, Nancy? So I'll drop that in the chat. And then Stephen, if you want to dive deeper into that recording from session 2, we'll resend all those links out. Really dives into that analysis piece.
Awesome. Thank you very much.
Yeah, absolutely.
Tracy, you were the first one who joined us this morning. And
Nancy, you
now I'm
can't go cold
I
calling people
know,
now. You're
well,
gonna make people
I
drop
know
off
it's
fast.
terrible. But we were chatting. Uh, this was Tracy's first session of the 4, and we hope that you found it valuable.
I think one sort of final point, if there aren't other
Oh,
questions,
Tracy
is
just came off mute. She was brave
oh,
enough
there we
to
go.
Nancy called her out.
I'm sorry.
No, thank you. I was just saying this was a lot of information. This is good. I'm processing. Thank
Okay.
you.
I think we talk about fiduciary responsibility again. Is it a fiduciary responsibility to consider impact? Again, Kelsey was talking about a affordable housing development that over 10 years had very safe, secure funds that were tied to something called the AFR, which is the applicable federal rate, which you would think is a catalytic return, meaning to get impact, to unlock, you are giving some return up because it's focused more on impact. If you look at that return over 2016 to 2026, it averaged about 4.5%. If we look at portfolios, which we do every day, and see that they held a general bond fund like the iShares Aggregate Bond Fund, AGG, that over the same time period, not catalytic, returned 2.5%. And so I think there's all this you need to be cognizant when you do something that's catalytic or about return. But there's all these arguments that are like, well, because we don't consider impact, it's not catalytic. Well, might be, depending on what you have in your portfolio. So I just to open that up, I think there are sometimes these conversations can get shut down at the board level because they'll start talking about fiduciary responsibility. It's a very important conversation. It's just nuanced, is important to remember.
Perfect closing comment. It's become my go-to that I pull out of the pocket.
Well, we are actually right at 12:15. So we did it. We jammed a lot in there. And so it'll take us a couple of days to get the recording up and load it onto YouTube and get it on a page and get a summary together for you all. But we will send that out and hopefully you'll take another look at it and maybe it will help fill in any of the gaps that you might be feeling right now after we just threw all of this at you, 40 slides in 45 minutes. So if anyone has any last questions, I put all of our email addresses into the chat. So feel free to reach out. We are here. We exist to do this and to help the community, and we love to talk. So please feel free to reach out. And so I will lead the team in saying thank you for coming, and thank you for considering this type of investing with your organization. Hopefully, you've learned enough to be able to get started now in 2026. So good luck.
Thanks so much.
Thank you.
Thanks, everyone.
All right.
Bye-bye.
Bye,
Thanks.
everyone.
Bye.